So the first big question is this normal? And the simple answer is yes, it's actually quite normal. A correction like we saw today in broader markets is absolutely normal. But what is abnormal is the record number of days that we have seen without a greater than 2 to 3% correction, and that we've been in this environment for the last several months. This is why this stage of the market is called the winner's curse phase, because folks that are new here get suckered into the good times, start feeling like they're geniuses, and then have the rug swept out from under them right as they get levered up into positions that they bought at too high prices. That brings us to question 2. Is this the end of the run? And to that, I would say no. I was talking about this a lot in mid-September and even on the DCA podcast, how historical data shows that post-election years that see a positive August in markets, which we had, push that traditional September correction out to October. Now, while we started October strong, I think this is exactly what we are seeing right now. And just for context, October is historically the most volatile month of the year, as you can see by this chart here and what we mentioned in the intro. And I'm sure you all noticed that volatility during this trading week. And I'm talking before Friday, where we were up Monday, down Tuesday, up Wednesday, down Thursday, all over the board, swinging like we haven't seen for a very long time. Additionally, we have been discussing how institutions are historically underweight equities compared to retail. Retail really bought up that dip in April in much greater numbers than institutional players, and those large players have been looking for an excuse to wipe out historically over-leveraged retail positions. So they're looking for entries at lower prices, and I think we saw some of that pressure to get them those entries today.